Hey, welcome back, everybody, to today's Market Explained podcast, a financial podcast. I'm your host, Brian Kasal, and I'm here with my co-host, longtime co-host, Mr. Christopher Reardon. Chris?
Yeah, thanks, Brian. Good afternoon, everyone. And hope everyone is enjoying coming into March now, and glad to be here and talk a little bit about the markets.
Well, March came in like a lamb, and it's going out like a lion, or then kind of like a lion, not like a lamb. So we're having some pretty rough markets and a lot of strange things going on in the world. So, Chris, tell us what is going on in the markets right now.
Yeah, one thing I'll highlight from kind of a general asset allocation perspective that we're seeing, because we're starting to see a little bit of movement, which I think is interesting. I'd like to kind of highlight domestic equities, which has been a long time number one we've talked about. It's at 319 now, and it actually moved down 6 points from our last podcast. And conversely, commodities is now at 272 plus 5 from the last podcast. So we are seeing a continuation really of this trend where both of those are kind of coming, getting closer and closer together. If that continues, we could see commodities, overtake domestic equities in that number one position. So
Mhm.
it'll be really interesting. I mean, there still is a pretty good gap there, pretty good sized gap. But, if we even have, a couple more days or weeks even of, essentially net 10, 11 point moves, you can see how quickly that gap can close. So that's, I think, a really interesting thing for us to keep an eye on. The bottom four asset classes have been relatively stable, I would say. International equity is still in that third position at 213 equal from the last podcast. Cash is at 128 and fourth equal from the last podcast. Fixed income did gain 1 point, 81 to 81 in fifth. And currencies is still in last at 78. So I think the really interesting dynamic here to see is that commodities and domestic equities relationship and see if we do see commodities take a leadership role. I will say if that does happen, from what we've seen in the past, usually it's a short-term leadership gain. We usually don't see commodities taking leadership role for a year, 2 years, 3 years. It's usually, a short period of time it would maybe take that over. But we'll have to kind of see from that perspective.
Mhm. Well, it is interesting. We started the year a little rough, and then we had a big rally. We started to get signals to take protection back then in early January, and then all of a sudden we got a big rally, and it continued and continued, and now we're seeing a big downturn again. So we've given back that rally, and the Nasdaq, the technology heavy Nasdaq, is was up almost 6 or 7%. Now it's down. It's down 2.4 now. Had been down a little bit before, so a little bit more before. So it's down more than 10%. So it's in correction territory, right? So
Mm-hmm.
there's a correction. 20% is an outright bear market. So that's where we are. And even as early as March 1st, last Friday, S&P was up 1.24, but now this morning it's down 1.54. So we've had a couple really bad days here. We're on Wednesday of this week. And then, of course, the only thing that's half working is the dividend stocks. And many of them are embodied in the Dow Jones and the Russell 1000. The Dow is flat on the year. It was up a couple percent. So there's a flight to quality when there's concern about technology. So that's what we're seeing here today, Chris. But that's that's an interesting start. The best names of the year so far are dividend-oriented names.
Yep. Yeah, and I think best sectors really so far too. Financials kind of got beat up they got really hit
Mhm.
hard this week, so they were clipping at that level. But healthcare has been great this year so far.
Yep.
It's up. I think the Vanguard healthcare ETF is up about 6.86% year to date. So it is still positive. And I think that kind of plays to what you were saying, Brian, as far as more conservative names. You also have consumer staples that's right in that alley as far as conservative names, and surprisingly real estate, once again dividend payers, more steady. Real estate is actually up 4.91%, the Vanguard real estate fund. So
Mhm.
there are some sectors that are obviously holding up better, but
Mhm.
I agree, Brian. I think we've seen I don't know if it's a flight as far as fear of a downturn, but we've definitely seen almost an exodus out of these tech stocks, at least in the short term. A lot of being pulled out of those and moving more towards safety, if you will, whether that is dividend stocks or we've also seen the U.S. Treasuries, the yields on them drop significantly. So there's this flight to safety for U.S. Treasuries as well.
Yeah, and that's the normal reaction. But in 2022, the normal reaction didn't happen because interest rates were rising at the time that the market was going down. So bonds were down big. This year, bonds are not down big. They're, they reached a level and now they're kind of tailing off. But now they're acting the normal way bonds act when the stock market's getting hit. The bonds rally, and the interest rates on the bonds go down because the prices are going up. So that's a normal relationship, Chris. So that's good. That's good to see because it wasn't that way.
Yeah, yeah. I mean, that's what we would expect to see, right? I think the U.S. 10-year Treasury is actually at its lowest level since October. I believe this week it's at like 4.11%. So,
Mhm.
we continue to see that yield falling, that kind of flight to safety action there as well. So, I think the big news this week, I think, as far as what's really jostling the markets is Donald Trump, we've talked about this before, but he did put in to effect the tariffs that he had kind of brought up a month ago and then delayed a little bit. So that was kind of a 25% tariff on goods from Mexico and Canada, and then a 10% tariff or import duty on goods from China. So, with that, we've already seen a retaliatory response both from Canada. Mexico, I don't think has it fully announced last I saw, but then China kind of came out and said they were going to put additional tariffs on American goods, 10 to 15% in that range. Their primary targets were agricultural and food product goods, but they were also placing 25 U.S. companies under export and investment restrictions, which
Mhm.
obviously we're in more of a free market, but in China, I mean, you really have to kind of play ball over there. So they have a little bit more they can do as far as restricting if they want to U.S. companies there, things like that. So it's an interesting dynamic. I think that's what's really jostling. It jostled the markets really this week. I
Yep.
think but yeah, Brian, if you want to add anything to that?
Yeah. I mean, there's a lot of things happening. Bitcoin is getting hit. The tech and AI stocks are getting really crushed. And we're seeing the economy slow down. And Chris, today the ADP jobs number was expected to be 141,000 jobs for the previous month, and it came in at 77. Now there'll be more revisions, but it was a lot lower than expected, and that's unusual. We've seen all the numbers in the past always met or exceeded estimates. So there's some concern that the previous administration wasn't giving out real numbers, like they were giving out numbers that made them feel good, look good, but good messages and things like that. So here's a real number. It didn't work. We're down in job growth as expected. And a big part of the economy has been in recession for quite a while. But the consumer spending side wasn't. Now, if employment is down, it's going to affect consumer spending as well. So we'll see. That whole discussion about GDP, Chris. It's C plus I plus G: consumer, investment, and government. Consumer is going down, investment is going down, and then the government, we're seeing they're slashing spending dramatically. Trump was saying last night in his big speech that he wants to balance the budget. That means we're going to cut 2 trillion of spending from the previous year out, because that was about the deficit last year. In the last 3 years, over 2 trillion. So it's almost inevitable that we have a recession. The question is, how hard is it? GDP now, which is the Atlanta Fed's program, Chris, coming into February, coming into late February, they said it was a positive 2.3%. Then they got a whole series of data in, and it went to negative 1.5 estimate for the quarter. And then yesterday, they revised it again down to negative 2.8 for the quarter. So they're now predicting a negative first quarter. And a recession is 2 quarters in a row of negative GDP growth. So we'll see if we have the first one and then we get another one. We'll see. But then the question is, how bad does it get, right? How deep does it go, and how does the market react to it? But clearly, the market's going to have some weakness in here, probably, Chris, if we have recession numbers.
Yeah, and I think it's, it's going to be interesting to see. I think in some ways it's a little unprecedented, and I think that's why some of these things I think have to be taken a little bit with a grain of salt. Is we've never really seen government cutting spending as aggressively as this administration has been. And even I mean, we've seen tariffs before, things like that, but that's still a big X factor right now. I mean, we don't know how long it's going to last. I would imagine not very long, just due to the impact, especially with maybe China could last a little bit longer, but with China or with Canada and Mexico, we're such a imports from them are such a big, or exports from those countries to America are such a large portion of their GDP. I would imagine is not going to, last for a year per se. Yeah, I mean, I think it's just really interesting. I mean, you look at some of the economics that came out since our last podcast. We got a second estimate for the Q4 GDP, and that didn't change. So, I mean, we still grew. Right now, their estimate is at 2.3% Q4. So, we still saw that growth there. In January, we saw durable goods orders came in at 3.1%, which actually was a major upbeat. The expectation was 2%. So we still see some spending there. On the flip side, the manufacturing PMI for February came in at 50.3, which was below expectations, but still slightly expansionary right there. Anything above 50 is kind of growth, below is contraction. So, we're right on that cusp, I want to say, and we're getting a lot of mixed signals. The other thing I'll highlight that came out with the payrolls number is wages, and I thought this was interesting. Wages for workers that had changed jobs kind of in the last year advanced 6.7% year over year, which is a pretty good number actually. When you think about it, you look at it, especially where inflation's at right now, and that's a good sign, I guess, from a consumer standpoint. If they have that, hopefully they can, keep up with the inflation or get things back under control. But interesting that the dichotomy between that number and the number for people who did not change jobs in the last year was 4.7%, which was actually unchanged year, from the year prior, growth wise. So, interesting, I think, dynamic there. But the last thing I'll highlight, which is kind of interesting to see there. I should say two things. The US dollar, what impact does this have right now? Well, right now we're seeing the US dollar just plummet essentially. Now it's at a 3-month low, mostly off of slowing concerns, from the unknown of the tariffs, things like that, some of the economic data we're seeing. That dollar is going to fall if the market is expecting the Fed to lower rates more, right? So if they see weakening economy, things like that, we're going to see that dollar fall, especially quickly. And then the last thing I think it's important to highlight is we're now less than 2 weeks out before a March 14th deadline for Congress to avert a shutdown, government shutdown. So that's another looming unknown out there as well. So yeah, I think that's the biggest biggest thing right now is there's just a lot of unknown variables as far as what the impact's going to be of some of the current narratives that are driving the market, really.
Yeah, I mean, it seems like every other minute there's some new news that came out. We expected today to be down on these numbers, these employment numbers, and then it was rallying, and we found out, well, of course, Trump came out and made some comment about how some of the tariffs might be turned back or settled, or he implied that might be the case. And I know his intention is to get the other countries to change their behavior. They've been tariffing us for years, and people really didn't realize it, and we still survived as an economy. But Trump wants to even the playing field, where either no one has tariffs or they all have the same tariffs, but not unfairly toward the United States. So it's all his objective is here. But you know, every other minute they come up with a new news item, or something releases, or somebody tweets something out, and then the markets react to it. So we're kind of in that mode, Chris, where since there's so much uncertainty about what the tariffs will be, it really didn't matter much in the Trump one first term. There were some tariffs put in there, but actually we had the lowest unemployment in a long time. We had the lowest inflation in a long time, and strong economic growth. It was actually the 4-year period of time, one of the best economic periods of time in the last 100 years in America. So there were tariffs before, and it didn't affect that much. I think he's being more aggressive now. So a lot of uncertainty. Plus, it's different than how we're doing it. We're doing it for policy reasons, to get, the border closed, to get fentanyl from stop coming into our country and things like that. So it's not really economic. But it is economic because the tariffs are imposed, right? And it can change the trajectory of different products and services, and who can import what and everything like that. So, and then it affects jobs as well, because if you're in a product that all of a sudden gets tariffed, maybe you guys can't sell anything, or you could sell more internally, but you can't sell more overseas. Maybe some of the input costs you're bringing in from overseas are higher now because of tariffs. So a lot of different things. Trump wants people to manufacture in the United States, and Taiwan Semiconductor just announced a $30 billion investment in a huge plant that's going to be built in Arizona. They've previously done all their work overseas in Taiwan. So that's an interesting thing. So Trump is trying to change the economic order of the world and make it more fair. And then he thinks we are going to have an enormous boom in America. That's what he's planning. So we'll see if this works. It should actually work, but it's going to be a little chaotic in the meantime, right, Chris?
Yeah, I mean, and I think, I think it's a great point to point out that, I mean, Trump did put tariffs in place back in his prior administration too, or term. But I think what makes this a little different from the chaotic side or volatility side of it is there's so many different things in play right now, and there's so many different kind of scenarios that could play out. Not only do you have the tariffs, you have kind of the Ukraine-Russian conflict and all the drama and the geopolitical tensions going on there. Anything from a continued extended war, what that would bring to the markets, including oil and everything, to potentially, is the war get ended? Does Russian oil start to get back more formally onto the market? What impact does that have? So there's just so much that's out there right now. So many different scenarios that could happen that could have drastic impacts on the market, one way or the other. And there's no way to see which way it's going to fall. So I do think it's really interesting. I mean, I think obviously bringing some of that manufacturing, especially from semiconductors, onshore does make sense. I know, there's been bills put in place to try to do that, and try to kind of promote that on top of this. So, I mean, I think a lot of people in this country, I would say, even would agree with that, kind of with what we experienced with the pandemic and everything. And I think it also makes sense just from the tensions, the geopolitical tensions across the globe with China, and some of the posturing they've had towards Taiwan, things like that. We really have to be careful because we don't want to become so reliant. And then if something were to happen, heaven behold, we would be really stuck trying to play catch up.
Yes.
So
Yes, Chris. Well, and we saw an unprecedented amount of spending and from the Biden administration after the election, when Trump was elected, until the inaugural. They spent and authorized 1.7 trillion of the entire spending for the fiscal year. But now, of course, the Trump administration is trying to claw much of that back. Some can't be clawed back, but much of it can be clawed back, and that's the spending that they're canceling. You're hearing these stories if you watch the conservative press. Actually, I don't think the mainstream media is covering this because they seem to have a different objective, it seems. But you do hear about this in the conservative press. 1.7 trillion is spending, and much of it's being clawed back. Interesting as well. The Fed president, Tom Barkin of Richmond, the Richmond Fed. Yes, there's a Fed bank in Richmond, Virginia, believe it or not. And there was an unprecedented amount of fiscal and monetary policy response to the pandemic that accommodated this price pressure. And what he meant basically is the inflation was caused by all the spending during the pandemic. And people have been saying, well, that really didn't happen that way. And, now we have the Fed actually empirically looking at it and saying, yes, that this is what happened. And so all that spending that the Biden administration has done in the last 3 years also caused inflation to run up, and has also kept it stubbornly high. They wanted it to go to 2 or below, and it's still in the threes. So it's really difficult right now. So hopefully that inflation number does go down. If the C plus I plus G equation, GDP is going down, then most likely the inflation will go down, and that's what it looks like is happening. So.
Yeah. Well, and I think we've talked about this. It's really hard to bring inflation down when you have a strong jobs market, labor market. I mean, if you have people willing to spend, and you see it, I think most prevalently even like with travel. I mean, anyone that's traveled anywhere and been to an airport, been to a resort or anything, I mean, everything's packed, right? So people are still wanting to spend. If you don't have people that aren't willing to spend, then you don't see that people having to cut prices, things like that. So, you have to have that contraction there, as painful as it can be, to really fully rein in inflation. So, I think there is some justification there, if you will.
Yeah. Well, and another thing that could cause difficulty for the economy are wars, and the Ukraine war with Russia. Now it looks like they are going to settle it because President Zelensky is coming back to the table. The Russia, they think they're justified in going into Ukraine because of things that Ukraine had done. Ukraine thinks that Russia should not have done it, obviously. So that's how war develops. But war is very expensive, and also in lives, right? The thousands and thousands of kids, young fighters have passed away. And so the best thing to do, especially for the country and the world, is to settle wars and not have wars go on and on and on. And also it creates less disruption for the economy as well. So that being settled would be a good thing. But the bloated government spending that we've seen, has created a lot of issues. The new Treasury Secretary Bassett, he said 75 to 80% of the jobs under President Biden in the government were government or government adjacent, like healthcare and related jobs, and they crowded out the private sector. Virginia Governor Youngkin is working on private sector jobs. The growth of jobs should be in the private sector because there's more productivity in the private sector than in the government sector. And so that's what we're seeing now more and more. I think the Trump administration is trying to reduce dramatically the number of government jobs and then turn around and have that affect positively the private company market and the economy, and then more job growth in the private sector. And I think that's a better model, because the private companies have the right incentives to manage employees, where the government, of course, just spends and spends and spends, and there's no accountability. Until we have a president that's looking to cut. So that said, Chris, there's still tons and tons of lawsuits. So the Doge group is making cuts, and now there's like 75 lawsuits against the president. The Supreme Court of the United States is being called in all the time. Can this happen? Can that happen? So we're going to constantly be hearing information about all the ups and the downs of the cutting of spending and everything. Darrell Issa, the congressman from California, is now putting through a bill to put restrictions on federal judges, that when one group who is losing their funding doesn't like it, they go find a judge anywhere in the country. There's 700 federal judges that will rule favorably for them. They believe that they will. Then they go to one federal judge that can affect the policy of the whole country. So they're trying to change that. So no one federal judge can affect the policy for the whole country, maybe just for one instance, right? So they're looking to get that bill passed to keep these judges from, basically terrorizing the whole economy, which on both sides, one side, they venue shop looking for judges to get an economic result that they want. So.
Yeah, very interesting. And, one thing I like to turn it to a little bit from looking out to international markets. Couple like hot takes we got, I think, from the European continent. We got a Eurozone number, which actually came in pretty good. Their jobs numbers in the Eurozone has been strong. Their
Hmm.
unemployment rate came in at 6.2%, which was a record low. It's been at that level since October. So, we continue to see Europe surprisingly resilient, I think. Although to the flip side of that, Germany's Q4 GDP came in at a negative 0.2%. So that was that first negative reading that you had mentioned, Brian. So
Yep.
if we get one more in Q1, then that would be officially Germany's in recession. And that's a big deal. Germany is kind of known as the powerhouse, really the economic engine, if you will, in the Eurozone. So but on the bright side, we talked about it on the last podcast that Germany had an election upcoming, and kind of that center right conservative party did get the most bids, but the way they work is they have to form a coalition, and they just actually announced, I believe, their coalition that they're looking to propose to create a 500 billion euro infrastructure fund and overhaul some of the borrowing rules within there. So really trying to jolt the German economy a little bit more back to life. So that's obviously having a major impact, at least today, on the some of the international markets. So we'll see how that plays out. I know it's a little preliminary. It still has to pass and still has to kind of go on through there, but that's promising that we're releasing some maybe hopeful spending out of there. And then I think, on top of that, diving a little deeper, looking at commodities, we continue to see gold move upward. I mean, I think this is kind of the perfect storm really for it. We have a weakening dollar, which we talked about. We just also have tension and conflict. You have this safe haven demand, and that's usually seen there. So gold's up about 11% year to date so far, and we just continue to see that rally continues to be a strong asset so far. And on the flip side, oil, we're seeing oil move down this week. And this came after OPEC Plus announced plans to proceed with their output increase in April. So, OPEC Plus is looking to produce a little bit more oil. They also came out and said, with the tariffs and the trade tensions, they expect demand to be a little lighter. But I think the other unknown factor, which we kind of mentioned before there, is if we do see, a higher potential for de-escalation in Ukraine, that brings the terms of Russian oil becoming more readily on the market. So that could have a major impact on the oil markets. So that's one thing to at least keep an eye on, as some of these talks maybe start to play out. So interesting things to see.
Yes, absolutely. Yeah, the international markets are reeling from all the inefficiencies that they have as well. So we'll see how far they go downward. And Germany's negative now. Chris, you mentioned commodities. So commodities are a cost to everyone, right? And it's a cost to business as well. So if commodities are rallying, and the commodities that we use every day, like industrial metals and things like that, well, then that's not terribly great for the economy because it's an increase in cost. So usually when we have bad economies, we see commodities rallying. It happened in 2008. It happened in 2022, where commodities were the prime component of our dynamic portfolio. And so we actually had a pretty good year because we had the commodities, right? But yet the economy didn't have a good year, but we were invested in commodities. So we ended up having a decent year in that portfolio. So we have to be careful about that. But also we're seeing precious metals run. We were seeing grains run during the Ukraine war at the beginning, but not as much so now. But still, commodities are coming up. They're ranked number 2 out of 6, right? And it's been
Yeah, I mean,
every week.
commodities have been strong. Oil's getting precious metals, I think, have been pretty stable for the most part. Not a huge fluctuation there, but industrial metals, I mean, we're seeing a pretty good run there now. I think it's up almost 20% year to date. So we're seeing a bit of a pop there.
Yeah.
We're also seeing natural gas. That has high fluctuation, high volatility, but prior to this week, most of the country was just in a horrible deep spell of cold for about
Yep.
2 weeks. So, when you have those deep cold spells that go there, usually we see natural gas pop. So that's up about 21% year to date as well. So, there definitely is still, I think, a pretty strong market for commodities, and with these tariffs, especially and things like that, I think that is going to be a big volatility factor. Maybe as a whole, the it'll slowly move up, but under the hood, there's definitely going to be some major movements in some of those subcategories such as copper, natural gas, oil. I mean, that has obviously, as we talked about, big influence on the Russian Ukraine conflict potentially there as
Yeah.
well.
Yes. So interesting times, Chris. I will tell you, we're really looking at a new mindset, and I think the mindset in the U.S. is if it's not really required for the federal government to do it, then that's the basis of cuts that they're making. And in fact, they brought in an education secretary, Linda McMahon, and her express job is to put herself out of a job and to close the education department. They've also talked about closing the commerce department. These are departments that do things that were remanded to the states in the Constitution, and they're not really constitutionally required for the federal government to do it. So that's kind of what it looks like. So we have our bloated government spending. We're going in a different direction for the private sector to create jobs, not the public sector. And just recently, the new bill that was passed in Congress, this stuff does affect the economy, which is why I want to bring it up, substantially reduces spending and the deficit. So in 2025, instead of 2 trillion of deficit, they'll have 350 billion. But if some taxes come through, they could have no deficit whatsoever. The structural deficit in 2026 is expected to be just 250 billion, but it's much lower than the 1.7 to 2 trillion deficit of the last 3 years in a row, right? So kind of going through a totally different mindset.
No, yeah, I mean that's important. I mean, it's important. We've talked about it. It's something that's really easy to, especially for politicians, to kind of kick under the rug,
Mhm.
kind of kick the can down the road, if you will.
Mhm.
So the fact that it's being addressed now, I think, is great. Hopefully, some of those numbers. I mean, I think there's a lot of what's it called? There's a lot of prediction, if you will, with that. So there's uncertainty. So hopefully they come to fruition.
Mhm.
But I mean, I think we'll just have to kind of, wait and see. But I think at least the intent's there, which is good. And hopefully, if they can kind of continue with that intent, we can start to get this under wraps. Because if we just can't keep spending like this. I mean, we can in the short term, but at some point, we're putting future generations at a huge risk. And it's not really fair, to essentially, destroy the legacy of your children or your children's children, just because, you didn't want to deal with it today.
Yeah, and the president did say during the campaign that he's looking also to sell off assets to pay down debt as well. So they're going to pay down some of the debt from 36 trillion. If they could pay down 10 trillion of debt, that would be put America in a much better position. Our GDP is growing, but our ratio is too high. We're getting to Japan levels, and that's the most debt-laden country that of the major economic countries. Japan is the one that's most debt-laden of all, and it's caused basically a stagnation in Japan for almost 30 years. We don't want to get there. We want to manage this debt, and we want to get our deficits down and maybe pay down some of the debt, and certainly not put any more on for a long time, right?
No, yeah, I think that's for sure. I mean, I think yeah, it's definitely something we need to be careful of. It's easy to overlook, but the importance, I don't think, can be overstated.
Yeah. And then, Chris, so what has our response been to all this? We've gone now in a period of a couple weeks only to protection level number 2. So let's talk a little bit about that. We have 4 different moves that will get us from fully invested to a maximum cash level. And we have 2 portfolios that go to the moderate level, which is 50% cash. And, that's a lot of cash. I mean, when mutual funds raise cash, it's 10 to 11 to 12%. So 50% cash is a lot of cash, and it will protect you in a big down market. So we do that every time the market gets weak, but we don't always go to position number 4. So we're at position number 2. So if the account would go to 50% cash, it's right now 25% cash, or in soon to be there. And that's to protect on the downside. And that's how we got much better performance in 2020 and 2022 when the markets were down big. And so we just want to help clients avoid losing a lot of money, and us as well, right? Our portfolios are run this way also. So that's our response to it. And about 50% of the time that we go to protection level 2, we'll go all the way to protection level 4, just historically, and about half the time we don't, and it'll turn around and go right back up. So, but right now we're seeing a lot of the metrics and a lot of the indicators that we don't normally see turn quickly have turned quickly. So there's certainly some damage out there, Chris, isn't there?
Yeah, I mean, we've certainly seen just this past week, even some of our what we would say longer term indicators that are more heavily weighted within our models started to turn negative. So to us, that kind of means time to bunker down at least a little bit more. Hence how we're raising to position level 2. But yeah, I mean, usually when some of these, it's usually at least 3 months of kind of volatility is what the expectation is. So, and that's not doesn't mean that it's going to be 3 months of crazy down markets or anything. I mean, we've talked about this before, but sometimes you get the craziest bull rallies in a bear market overall. So,
Yes.
there is, it's definitely not going to be just this terrible, just straight down move. But I think the volatility is here to stay, at least in the short term, until we get some clarity.
Yeah, and some of the biggest rallies ever, as you said, happen in bear markets, right? So we go
Mm-hmm.
hit pounded, and then all of a sudden we have a huge rally, and everyone thinks, oh, it's all over, right? And then it takes out that rally and keeps going lower, right? So it's a big head fake thing going on. But anyway, that's our position right now is we're at protection level number 2. So we'll weigh in now because we're in this mode and where we stand in every episode. Normally 85% of the time we're fully invested like everybody else, but this looks like a time to be in protective mode. So we're going to do that. So Chris, in the what we see out there, there's some interesting stuff. I've got notes on the big travel boom. There's a big travel boom out there. In fact, I saw a report here from a high-end travel agency that $50,000 bookings for travel, big trips, big month-long trips on boats and things like that are up 50%. And then the $150,000 trips, the expeditions around the world and all that are up almost 80%. So people are spending money on trips. So maybe they're not spending money on other things, but they're spending money on trips. Isn't that interesting?
No, yeah, I mean, I think that's, and I'll be curious, and I don't know if we'll know, but is that a byproduct of kind of that COVID? I think that got under a lot of people's skin, not being able to travel, kind of being restricted, locked down. And I think you've seen this travel boom really ever since. That hasn't really slowed down. So, I don't, maybe that is just a shift, a dynamic shift. I mean, you do
Yes,
have, remote working capabilities opened up greatly after, even if it's just temporary, things like that. So, it'll be really interesting to see, I think, how that kind of plays out. I agree.
exactly. Well, good. Hey, I think that's all we have for today, folks. Chris, anything else?
No, I think that about covers it.
Okay, well, great. Thanks for being with us today, everybody, on today's Market Explained. We started our last episode in Antarctica, and now we're here back in Chicago. So we'll be back to you with another episode in a couple of weeks. We'll give you an update on where we stand with everything and where our position is on protection and all the things we're trying to accomplish for our clients. So if you don't have protection on your portfolio, you might want to give us a call. And thank you so much for being with us today. Bye-bye, everybody.